All right, let's get right into it. If you're a business owner or an investor, you know the tax code isn't just about paying your share. It's also a system full of incentives. And today, we're going to unpack one of the most powerful and honestly, one of the most misunderstood incentives out there: bonus depreciation.
You know, there's this saying that the game of wealth has a cheat code, and that cheat code is called bonus depreciation. And I love that framing because it's exactly right. This isn't just some boring deduction. It's a real strategy. It's an advantage that smart operators use to seriously accelerate their growth and get massive tax savings. So let's break down exactly how it works.
So what is bonus depreciation, really? Well, at its core, it's all about speed. It lets you immediately deduct a huge chunk, or even all, of the cost of certain assets, like equipment, vehicles, and even specific parts of a building. Think about it. Instead of taking tiny deductions over, say, 5, 10, or even 39 years, you get to take one giant deduction in year one. This crushes your taxable income for the year, and most importantly, it frees up a ton of cash flow.
This comparison right here really drives the point home. Let's say you buy a piece of equipment for $100,000. Normally, with a 5-year life, you might get to deduct $20,000 in the first year. Okay, not bad, but with 100% bonus depreciation, you deduct the entire $100,000 right away. The impact on your tax bill and your available cash that first year is it's night and day.
Okay, so this brings us to why we're talking about this right now. Some very recent changes in the law have completely supercharged this incentive. It's actually more powerful and more permanent than it has been for years. To really get why this is such a huge deal, you have to look at this timeline. Under the old rules, this amazing tax break was literally on its deathbed. It was set to phase down to 40%, then 20%, and then poof, gone completely by 2027. But a brand new law just restored it, not just back to its full 100% power, but it also made it permanent. That is a game changer for anyone trying to do long-term planning for their business.
So how do you actually use this thing? Well, the first and most straightforward way is with your business assets. This is the classic use case, covering everything from your company's machinery to its computers.
But hold on. Before you go out and buy a bunch of new stuff, there is one absolutely critical, non-negotiable rule you have to know. This is the foundation that makes this whole thing work or not work. And here it is. The asset must be used more than 50% of the time for legitimate business purposes. The logic is pretty simple, right? The government wants to incentivize business investment, not help you pay for your personal toys. The IRS is super strict about this. So if you can't prove it, you can kiss that deduction goodbye. A classic example you hear about all the time is a heavy vehicle. Let's say you buy a $75,000 SUV that weighs over 6,000 pounds. And, this is key, you use it 100% for your business. The rules allow you to potentially deduct the entire $75,000 purchase price in the very first year. That is a massive write-off. Let's put some real numbers to that. Imagine your business buys $100,000 worth of equipment. If you happen to be in the 37% tax bracket, taking that full $100,000 deduction could mean an immediate tax savings of $37,000. That is 37 grand in cold, hard cash that you can put right back into growing your business instead of sending it to the IRS.
All right, now let's level up and talk about a more advanced strategy: real estate. This is where bonus depreciation can become a true wealth-building machine, but it does require an extra step. It's a bit more complex.
So here's the problem. The tax code is very clear. The structure of a residential building gets depreciated over 27.5 years. A commercial building, 39 years. Because those time frames are way over 20 years, the building itself doesn't qualify for bonus depreciation. So, how do savvy investors get around this? The key, the absolute magic wand here, is something called a cost segregation study. This is basically an engineering-based analysis where experts come in and surgically break a property down into all of its little pieces. They identify everything that isn't part of the core structure, all the stuff that wears out a lot faster.
So here's how the process works. First, you buy an investment property. Then you hire a firm to do a cost segregation study. Their engineers will identify every component that has a depreciable life of 20 years or less. We're talking carpeting, appliances, light fixtures, even a landscaping. Since those items qualify, you can apply 100% bonus depreciation to their value. The result? A massive paper loss in year one that you can use to offset your other income. This chart gives you a perfect visual of what happens. The study basically carves up the property's value into two buckets. For a typical $1 million property, you might find that 75% of the value is the long-term structure itself. That part doesn't qualify. But the other 25%? That's all the short-term components, and that entire chunk is eligible for that immediate 100% write-off. So what's the bottom line? On that $1 million property, you could potentially generate an immediate year one tax deduction of $250,000. This can easily wipe out all the rental income from that property, and depending on your situation, you can even use it to offset your W-2 salary or other business income. It's huge. Okay, but as you can imagine, with great tax savings comes great responsibility. When you take a deduction this big, you had better have your paperwork completely buttoned up. This is not a step you can afford to get lazy on. And tax experts are really clear about this. Because bonus depreciation makes such a huge, immediate dent in your tax bill, you can bet the IRS sees it as a major red flag during an audit. They are absolutely going to want to see stone-cold proof that you are entitled to every penny you claimed. So what does that proof look like? You need it all. You need the purchase invoices, proof of the exact date the asset was placed in service, and for things like vehicles or equipment, you need detailed logs proving that it met that 50% business use test. And for real estate, that full detailed engineering report from your cost segregation study is your number one piece of evidence. It's non-negotiable. And that really brings us to the final, most important takeaway here. Bonus depreciation is not some shady loophole you're trying to sneak through. It is a powerful economic incentive that was deliberately written into the tax code to encourage you to invest. But it's a power tool, and it absolutely demands precision. If you're diligent, if you do your homework, and you document everything meticulously, it can be one of the single most effective ways to lower your taxes and supercharge your path to building wealth.